Let's just jump right in, because today we are unpacking a massive financial puzzle that literally affects every single one of us. We're talking about the distribution of global wealth. Throughout this explainer, we're going to stick strictly to the data to understand exactly how wealth inequality works. We'll look at some historical attempts to fix it through taxation, and then we'll explore a really fascinating, somewhat futuristic proposal involving artificial intelligence. Okay, let's dive right into this because the actual data, it's truly staggering. When you map out wealth distribution, on one end you have this immense towering amount of wealth held by just the top 1% of society. And on the other end, the bottom 50%. At its lowest point, that bottom half of society owned just 0.4% of total wealth. Let that sink in. Not 4%, 0.4%. It's just a striking objective reality of exactly how concentrated capital has become in modern times. So here is our roadmap for today. We'll start with the wealth inequality spiral, then we'll look at taxing the super rich, followed by global wealth tax experiments, and finally, we'll wrap up with AI and sovereign wealth funds.
Part 1. The Wealth Inequality Spiral, or the Mechanics of the Doom Spiral.
We hear a ton about this widening financial gap, right? But how does it actually happen? Well, the mechanics basically operate like a self-reinforcing loop. Step 1, wealth naturally accumulates at the very top. Then step 2, those wealthiest individuals use that accumulated capital to buy assets. We're talking stocks, businesses, prime real estate. Step 3, this massive influx of buying power pushes the prices of those assets up significantly. And then step 4, because those asset prices are now sky high, it becomes nearly impossible for lower income individuals to buy in and catch up. It's literally a mechanical spiral that just continuously accelerates all on its own.
Moving on to part 2, taxing the super rich and Gabriel Zucman's proposal. So with that spiral in motion, how do policymakers actually propose stopping it? Well, one highly debated solution comes from French economist Gabriel Zucman. His core idea is a global wealth tax. Basically, it's a proposed 2% annual tax on the total wealth and assets of billionaires and centimillionaires. But the absolute defining feature of this plan, it requires international collaboration. Zucman argues that countries absolutely have to work together under the same basic rules to eliminate tax havens. Because without that global cooperation, the wealthy can just simply move their assets across borders to dodge the tax entirely. Now, what's really interesting about this is exactly what Zucman wants to tax. We aren't just talking about abstract numbers sitting in some investment portfolio. That 2% annual tax would apply to total assets. So yes, businesses, shares, real estate, bank accounts, and offshore assets, but also highly tangible luxury items, things like luxury watches, fine paintings, and high-end cars. Essentially, anything that holds significant value would be assessed and taxed every single year to prevent any loopholes. So what's the end goal of assessing all that stuff? Zucman estimates that if this were implemented globally and with all those tax loopholes closed, this aggressive wealth tax could raise a maximum of $250 billion every single year, $200 to $250 billion annually. That is a massive pool of potential revenue for governments worldwide. Which brings us to part 3, global wealth tax experiments, a tale of 4 countries. Now, while a coordinated global tax might be a new proposal, the concept of a wealth tax itself really isn't. In fact, these taxes actually peaked in Europe back in the 1990s before most countries ended up abandoning them. Why? Well, historically, governments ran into 2 major hurdles. First, the costly administrative burden. Continually assessing and valuing private assets year after year, it often costs more to administer than the tax actually collects. And sure, AI might make this easier down the line, but historically, it's been a massive headache. The second, and honestly far more immediate risk, is capital flight. Wealthy individuals just relocate to other countries, taking all of their taxable wealth with them and totally draining the host country's revenue. When we look at how this actually plays out in the real world, we see 4 drastically different outcomes. Switzerland uses localized rules with no personal investment tax, and the rich tend to stay. Spain tried a solidarity top-up on fortunes over 3 million euros and quietly raised 632 million euros without a mass exodus. Norway, on the other hand, applied a 1.1% tax that included illiquid shares, and that sparked a sudden exodus of billionaires. And Argentina? They implemented a one-off pandemic tax and successfully raised billions. So the crucial point here is the stark contrast between Norway and Spain, because it perfectly illustrates the tightrope walk that governments face. Norway's lower threshold 1.1% tax, which targeted people who owned valuable company shares but didn't necessarily have cash on hand, triggered over 30 billionaires and multimillionaires to immediately pack up and relocate to places like Switzerland. Conversely, Spain's €3 million solidarity top-up raised €632 million in just its first year. For wealthy Spaniards, the tax was certainly an extra cost, but it wasn't quite high enough to make them uproot their lives and abandon their homes and businesses. And what about Switzerland? How does a country literally famous for attracting millionaires manage to maintain a wealth tax? Well, because the wealthy look at the entire deal. In Switzerland, private investors normally pay zero tax on profits from selling shares and personal investments. And you pair that massive financial benefit with high political stability, excellent public services, personal safety, and genuinely high quality of life. When you combine the whole shebang, Switzerland's wealth tax feels way less like a penalty and much more like a membership fee for a very exclusive, highly functional club. Then we have Argentina, which provides our final, highly unique case study. During the massive crisis of the pandemic, they implemented a sort of break glass in case of emergency wealth tax. It levied between 2% and 3.5% on fortunes over 200 million pesos. And it worked. It successfully generated about 247.5 billion pesos. But the real key to this success was that it was a one-time extraordinary contribution. It succeeded without triggering immediate capital flight purely because the wealthy knew it wasn't going to be a recurring drain on their assets year after year.
And that brings us to part 4, AI and sovereign wealth funds, the next oil.
Let's move to the present day and see how this builds into a completely different philosophical approach to the wealth puzzle, one designed specifically to tackle the impending tech boom. Senator Bernie Sanders makes this argument. AI is being built from humanity's collective knowledge, our books, our art, our code, our research, and our data. Now, interestingly, this broader concept of addressing tech's wealth concentration actually has bipartisan interest, capturing attention from political figures ranging from Bernie Sanders all the way to Donald Trump. The core argument here is that if artificial intelligence is going to generate trillions of dollars in value, that wealth shouldn't go exclusively to a handful of tech billionaires and venture capitalists. So, the mechanics of this proposed sovereign wealth fund alternative work a little something like this. The idea is to put 50% of major AI companies into public hands. But rather than taxing them in cash, which, let's face it, can really complicate business operations, big AI companies would pay a one-time tax using company stock. That stock then goes into a public fund held on behalf of ordinary Americans. From there, the fund would pay out citizen dividends, basically transferring the wealth directly while also allowing the public a degree of influence over how these hugely powerful AI companies behave. Now, this concept isn't actually entirely without precedent. It's just that the resource in question has evolved. Think about it. In the past, places like Norway and Alaska took geographically limited resources, specifically oil wealth, and used them to build highly successful sovereign wealth funds that secured a high standard of living for their citizens. Looking to the future, proponents of this new fund suggest that human data and AI represent the next oil. By that logic, this modern digital resource should similarly fund a high standard of living for the public whose very data trained it in the first place. Of course, as an impartial explainer of the data, it's vital we look at both sides of this intense economic and political debate. Supporters argue that this policy is absolutely necessary to prevent the creation of AI trillionaires, especially at a time when ordinary workers face the very real risk of losing their jobs to automation. Critics, however, argue just as forcefully that seizing 50% of a company's stock constitutes a massive government takeover of private industry. They point out that this inherently risks completely scaring away the investment and innovation that makes the tech boom possible to begin with. Which leaves us with a pretty profound question as we face this new frontier. If AI truly is the next oil, built upon humanity's collective knowledge, who should own the well? It's a massive, complex puzzle of inequality, taxation, and technology that our society is going to be forced to solve in the coming years. Thank you so much for joining this explainer. Keep questioning the data, and we will catch you next time.